Okay, now that we have prepared the cash budget, we are ready to do the budgeted income statement. So the budgeted income statement is going to show our predicted amounts of sales and expenses for the budget period. So let's look at it for Toronto Sticks Company. So on our slide here, we can see that the budget income statement is taken from the components that we looked in previous slides. The predicted amount of income tax expense for the quarter is computed as 40% of our budgeted pre-tax income. For Toronto Sticks Company, the taxes are not payable until January 30th, 2020. So they're not shown on the October to November 2019 cash budget. So now let's look at our... Okay, on our budgeted balance sheet, it's going to predict the amounts for the assets, liabilities, and equity for that budget period. And we can look at it for the Toronto Sticks Company. So there's a lot of information on here. It kind of gives you a summary in the information down here. I'm not going to go through each one of them, but this is helping us prepare our balance sheet so that we can make sure our assets equal our liabilities plus our equity in our accounting equation is in balance. When we think about budgeting, it's a little different for service providers. They're going to use master budgets, but typically they have fewer other budgets, or fewer operating sections than manufacturers. But it's still important for a service company to include sales, the direct labor, the cost of expenditures, the cash budget. They might look at selling expenses, and then their general administrative expenses. And then they have their budgeted financial statements. So they're not going to prepare production or direct materials budgets, but they are going to have more of a direct labor budget focus. All right, so let's look at our next one. We're going to be looking at analyzing expense planning for activity-based budgeting. So activity-based budgeting is where we focus on an activity as the focus, rather than things such as salaries, supplies, depreciation, and utilities. Traditional budgeting systems list those kind of things, and with a traditional budget, management often makes across-the-board budget cuts or increases. For example, management may decide that each of the line items in the traditional budget has to be cut by 5%. It's not always a good strategic decision. So activity-based budgeting is a little different. It actually requires management to list activities performed by, let's say, the accounting department, like auditing, tax reporting, financial reporting, and then cost accounting. Understanding those resources that are required to perform the activities, then the costs associated with the resources, and the way the resource use changes with changes in activity levels allows management to better assess how expenses will change to accommodate changes in activity level. And that's kind of what we're looking for. All right, that concludes chapter 22. We do not cover the appendix, which is listed here. So if you have any questions, please be sure to reach out.